Hi, it's Alyse at North Shore Wealth Management. In this video, I'm going to discuss the tax treatment of several different sources of retirement income so that as you are building your retirement savings, you can think about different ways that you can structure it. I'm going to walk through a hypothetical scenario where a retired couple is preparing their tax filing, and it's a married couple filing jointly that has three different sources of retirement income between them. They are going to have Social Security income. They're going to have money that they pull out of a taxable brokerage account as they need it, and they have money they're going to pull out of their Roth IRAs as they need it. And we're going to talk about how each of those different sources of income are taxed differently. I need to disclose to you that I am not a CPA. I am not trained nor certified to offer tax advice or assist anyone in their tax filing. But all of the information we're going to discuss in this video is public information that's available to anybody online at irs.gov. And before I get started, I want to tell you that you should grab a piece of paper and a pen. I'm going to throw a lot of different numbers at you. And I suggest that you pause the video, write things down, process that information, and then move forward. That's how I like to process information when a lot of numbers are being thrown at me. I'm going to go ahead and get started. The first source of retirement income in our hypothetical scenario for our retired couple, age 67, married couple filing jointly, they are collecting Social Security benefits. For simple math, the average Social Security benefit for a 67-year-old in the US is around $30,000 a year. So we're going to say they each collect $30,000 a year for a total of $60,000 in Social Security benefits for their household. Social Security benefits are taxed as ordinary income, but not all of them. There are thresholds that determine how much of your Social Security benefits are taxable. And those thresholds are determined by how big your Social Security benefits are. The highest threshold is 85%, so no one's paying taxes on more than 85% of their Social Security benefits. Some people are only paying taxes on 50% of their Social Security benefits, and some people owe taxes on none of their Social Security benefits, and that's all determined by how much you receive in your Social Security benefits. But we're going to come back to that later in the video. We're going to move on to the second source of retirement income in our hypothetical scenario. And this couple has a taxable brokerage account. A taxable brokerage account isn't traditionally used. It's not traditionally a retirement savings account, but a lot of people use it that way, and I'm going to explain why. In this scenario, we're going to say this couple inherited a house about 10 years ago, and they decided to sell that house, and that gave them $500,000 in cash that they wanted to invest in the stock market. So they invested it in a brokerage account, and over the last 10 years, their shares of stock have doubled in value. And now they are selling a few of those shares so that they can pull $60,000 out of that brokerage account to use for spending income, to use for their living expenses. So half of that $60,000 they pulled out is long-term capital gains, subject to long-term capital gains taxes. And that $30,000 in capital gains is going to be stacked on top of their $60,000 in Social Security benefits. So they have $60,000 in income from Social Security benefits and $30,000 in income from capital gains for a combined total adjusted gross taxable income of $90,000. And that $90,000 is going to determine which tax bracket they land in, even though the capital gains is going to be taxed at one rate in one tax bracket, and the Social Security is going to be taxed at a different rate in a different tax bracket. They stack them together for a total adjusted gross taxable income to determine which tax bracket they land in for both. The lowest capital gains tax bracket for a married couple filing jointly has a tax rate of 0. And the ceiling for that lowest capital gains tax bracket for a married couple filing jointly is $98,000 and change. in adjusted gross taxable income. And our couple currently has $90,000 in adjusted gross taxable income. So they are below the ceiling. They are below the threshold. They qualify for the lowest capital gains tax bracket and the lowest capital gains tax rate, which is 0. They're going to pay 0 taxes on their $30,000 in capital gains because of the tax bracket they landed in. And then we're going to add their third source of retirement income, and that is their $30,000 that they pulled out of their Roth savings. It could have been his Roth, her Roth, or some of each. It doesn't matter. As a household, they took $30,000 out of Roth IRAs. Their Roth distributions are not taxed. No one's Roth distributions are taxable. Not only are they not taxable, they are not added to the adjusted gross taxable income because Roth distributions are not taxable income. So while they added $30,000 to their retirement income for the year, their adjusted gross taxable income remains $90,000. So they remain in the lowest capital gains tax bracket at a rate of 0. This gives them a total of $150,000 that they have accessed to spend as retirement income for the year. They have $60,000 in Social Security benefits. They have $60,000 they pulled out of their taxable brokerage account, and they have $30,000 they pulled out of their Roth. That's a total of $150,000. To recap, the Roth portion isn't taxable, and the half of the brokerage withdrawal that's capital gains is taxed at 0. So now it's just we just have to determine how much of their Social Security benefit they owe taxes on. They're going to consult with a CPA to determine which threshold they fall into. Like we said, they either pay taxes on 0 or 50% or 85% of the $60,000 they have in Social Security benefits. But no matter which threshold they land in, they still qualify for a federal income tax deduction, a standard deduction. And as senior citizens over 65, they qualify for an enhanced tax deduction for senior citizens. And currently, the One Big Beautiful Bill Act provides them with a rather generous enhanced tax deduction for senior citizens. It's temporary. It may become extended or it may expire in a few years, but currently under the One Big Beautiful Bill Act, their enhanced tax deduction as a married couple filing jointly over age 65 gives them a tax deduction of $47,500. So of the $60,000 they have in Social Security benefits, they deduct $47,500 of that from their taxable income. That means they only could be taxed on $12,500 of all the money they accessed for retirement income for the year. Of the $150,000 they spent as retirement income, only $12,500 of it has a tax bill. And as far as how big that tax bill is, their CPA is going to determine which tax bill they still land in, which tax bracket they still land in, and which threshold they land in, which portion of their Social Security income is even still taxable. The point of this exercise is to illustrate that how you choose to structure your retirement savings can give you a lot of control over the tax bracket you land in retirement. And that's something you'd want to seek help on from a financial advisor. That's something a financial advisor offers, is helping you structure your retirement savings in a strategy that makes the most sense for you. It can be different for different people. We didn't discuss 401ks. In this scenario, we could say that this couple also has 401ks that they built over the course of their careers. And once this couple reaches their mid-70s, they're going to be required to take minimum distributions from their 401ks. And if their 401k balances are large, then their required minimum distributions could be large, and those could significantly add to their adjusted gross taxable income and place them in higher tax brackets. But right now, at age 67, they're not required to take any money from their 401ks. So in this scenario, we're going to say they didn't take any money from their 401ks, because even if they only took $10,000 out of their 401ks, that's all taxable income. So as it stands, they have $90,000 in adjusted gross taxable income, and that keeps them in the lowest capital gains tax bracket. But if that adjusted gross taxable income got bumped up to $100,000, then that would bump them into a higher capital gains tax bracket and a higher tax bill. I would never discourage anyone from contributing to your 401k. There are a lot of good reasons why you should be contributing to your 401k. The first one is the employer match. A lot of employers offer a 401k match. If you have a $100,000 salary and your employer offers a 5% match, well, now you have a $105,000 salary if you just contribute enough to your 401k to qualify for that 5% match. And I would never discourage anyone from accepting an additional $5,000 in income from your employer. The next reason is the tax deduction. Any portion of your income that you move into your 401k is income that you won't owe taxes on for the year. And the third reason is something we don't really talk about much, but it is the discipline and structure that are provided in a 401k. If you pull money out of your 401k before you're supposed to, you're going to be penalized. And those penalties are enough to prevent most people from pulling money out of their 401k before they're supposed to. And for a lot of people, that's the only reason anyone has retirement savings at all. Some people lack that self-discipline on their own, and if money is easily accessible to them, then they're going to access it and spend it. So that is a benefit to the 401k. If you're the type of person who struggles with your savings and spending habits, then maybe you need the structure of a 401k to prevent you from spending that money now, so that by the time you do retire, you have some money saved for your retirement. I hope you found some of this informative and helpful. And if any of this is a conversation you want to continue with me, I'd be happy to talk anytime. Wherever you're seeing this video, you're going to see a link to my website, which is northshorewealthmanager.com. On that website, you can find a lot of different ways to contact me, and I would be happy to talk. In the meantime, you take care.